The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
Welcome to The Last Call. It is the final Friday of the month. Cheers to that.
Cheers to that.
And cheers to you.
Cheers to you, Nadine. This was meant to be the month. Sell in May, go away. Didn't happen. We're up about 3.6% over the course of the month, despite all the volatility and the back and forth over Trump's tariffs.
Yeah, it is pretty incredible. We were just chatting with Shane Oliver, of course, chief economist at AMP, saying that look, this week it was good news in regards to trade, but you never really know. So we'll take the short term. We'll take today. Actually, we barely, but we did go our own way. Adam Dawes, come on over.
Up 0.2% as we get into the last 40 minutes or so of trade. But of course, it was a bit of a better session on Wall Street overnight, and that was thanks to the fact that the Trump tariffs then had been reversed somewhat. Of course, it's going to be continued to go through the courts, one would imagine. And of course, we're reacting to Nvidia too. So let's get to our panel.
Yeah, we have Anita Costa joining us from IFM Investors. We've got Luke Winchester from Merewether Capital. Nice to see you again. I love making hay while the sun shines. Adam Dawes, naughty person,
yes,
Sean Partners.
I'm here, definitely.
He's wandering away as we're going live to air, but right. you just can't train him, can you? All right. Look, just to start, I think at the end of April we were saying what an extraordinary month because it started with April 2nd, so-called Liberation Day. Did you, Anita, think that we would have this massive V-shaped recovery, the market up by 3.6%?
No. No, I mean, every time you turn around, the market just wants to go up. I feel like everyone just wants to be so optimistic. But, I mean, things look okay for now. I just don't know how things are going to look in the second half of this year, especially for the US. It'll depend on how the data's coming out, but you're already starting to see April data coming out that's, incrementally worse. May will come out potentially incrementally worse again. And then, it all comes down to the labour market for the Fed. And that probably won't be until October. So that's when I think the first rate cut is factored in for October now for the US when they have some more concrete information on the labour market.
I hate to push the point, but what is it? Is it FOMO or is it just misplaced optimism or?
Yeah, I think it's valuations, right? It's the multiple. I'm not sure that the earnings have tracked up a bit, but I think for the US at the moment, they came down a bit over this reporting season. But then, 13% growth for next year is factored in by the market, which seems very optimistic because that's higher than what this year is. So I think it's just the expectations for earnings need to come down and the multiple's just been elevated at the moment. So it just needs to be corrected.
So Adam, does that mean we start to see cracks?
I think there's already started. We've started to see some kind of cracks going forward. I think you're right, the earnings revisions are definitely going to come down. I think the market hasn't really looked at those earnings revisions and then really started to see that happening. And so this earnings season's coming up is in the US as well as here in Australia are going to be really telling to see how that's going to happen. I think overall the economy is still looking okay, but cracks are starting to form, definitely.
What's your take been, Luke, on May?
Yeah, you had April 2nd, Liberation Day. We now have the name for it with the taco trade.
I love that we go along with every acronym or whatever.
What else are we going to do?
Bold, beautiful bill or whatever it is.
Taco is fun because he doesn't like that.
Yeah. I think we all believe that without having the name for it. Like, you saw the chart, the stupid numbers, and everyone was like, "No, this actually won't happen. Let's just go through the song and dance about it all." For me, I said it on the call at lunchtime, you got to remember as well, the market, it always moves on the incremental news. So you got that sort of big negative from Trump. Since then, you've had deals, you've had concessions, you've had certainty. So the incremental news has been positive. The problem is from an absolute level, we're in a worse spot than where we were. So the market going higher, it is unintuitive. Earnings will be the next driver. And I think when you talk about cracks, Dawsey, the problem is ex-Mag 7. A lot of those earnings revisions are coming from Nvidia and the other big tech stocks. They're still growing quite strongly, and below that, it's starting to look pretty weak. So Yeah, it's really interesting to see what we'll do second half of the year.
So where do you look for opportunity then, particularly when people are saying look away potentially from some of the big names? Maybe start with you, Anita, but...
Yeah, I think the key at the moment is to keep it domestic. Australia's in quite a different economic situation where could potentially benefit from all the tariffs globally, so see some disinflation coming through for us. And we've also got rate cuts coming through, which is positive for consumers, housing, everything. I've got a stock MA Financial, which I think is is the basis of that thesis is lower rates. It's quite a complicated business, but they've got a lending business which is going from negative earnings to positive earnings. That will do well from the housing market. That's underwritten by a whole lot of technology and data that they've got. They've also got an asset management business, which is largely private credit, but backed by real estate, and then also real estate assets themselves. So that will continue to do well under lower interest rates. So, yeah, I think thinking about stocks that are more defensive and definitely Australian focused.
It's so interesting, MA Financial, isn't it? Because we talk to them quite a bit on ausbiz.com.au. Our viewers would know, and it's often in the private credit, sphere. But you say it's a complicated business. There is a lot to it. So when we're thinking about businesses that will benefit from a falling interest rate environment, like that's top of your list?
Yeah, I think because they've got a lot of things going for them. So they're kind of like a bit like a REIT, which will do well when rate cuts are coming down from a macro perspective. And then they've also got the other large component, which is the housing related stuff. So I think that will also benefit from them. And they've got founder led. It's very undercovered, unknown from the street for the estimates.
Do you have anybody else have a view on MA?
I love it. It's a great story. Yep, absolutely, 100%. It's a great business.
Yeah.
Yep, absolutely.
And, sorry.
No, I don't have a view on MA, but I was just saying if your thematic is falling interest rates, your small lenders, they will benefit. I did the proviso is the short term because you got to measure that falling interest rates, lower interest costs for them, but also what happens to your bad debts on the other side, because obviously falling interest rates signals maybe some weakness in that economy. So they will be in that sweet spot though for a little bit, those small cap lenders.
I guess it depends on the delta of the interest rate cuts.
Exactly.
If this is a gradual rate cut environment and doesn't look like it's a dire situation, then that should also be positive from the bad debt side.
What do you think? Like, what's your gut feel?
Well, the market's saying I think it's a little bit maybe in July, then a little bit more maybe in August and September, and then I think a little bit more in December. So I think it was about 70 basis points cut over the rest of the year. That's what the market's factoring in at the moment, which I think that seems reasonable. And
it doesn't spell disaster for sort of other parts of the
disaster, no. I mean, a lot of it's going to come down to what happens in the US. I mean, it's an important part for a lot of the companies that are listed, but also, for Australians.
What consumer discretionary stocks then benefit from the falling interest rate environment? I had a really great chat yesterday to MST Marquee saying potentially the Temple & Webster's, the Harvey Norman, people sort of updating their homes.
Temple & Webster's already run, so
Yeah.
I think that's a little bit tougher. But look, yeah, certainly some of the discretionary retailers should do well. Yeah, definitely.
Yeah, I mean, don't have anything specific, but when you talk about falling interest rates supporting the consumer, your thoughts go to retail. I generally agree. Most retailers, they don't trade very cheaply, I think. They probably should have fallen more over the last couple of years, but have held up quite strongly and then also rallied. One, I don't own this, I must say, but it came up on the call the other week that I thought still looked reasonable was Baby Bunting. They're on that sort of recovery journey, so they're probably not humming as much as some of the others, so maybe value there. But your first thought does go to the retailers when you're talking about consumer discretionary and potentially more income in people's pockets.
Do you like a turnaround story, Lou? Because that's what Baby Bunting sounds like.
They say turnaround seldom turn, but then you can find plenty that do. The problem is you've got to sometimes sort of just have that iron stomach when you go in, because if you wait for things to actually look better, then they've already moved, and most of that trade's gone. So it's not for everybody, but I actually don't mind.
Okay,
go
all right.
that little bit early.
Adam Dawes on the call.
Yeah.
Oh, I don't want to drop anybody in it. It was Luke Laird from Seneca Financial Solutions, and Premier Investments came out or up, and forgive me if I'm wrong. I think he said, "Why would I pay 21 times?"
I remember this quote. Yes.
For a toy retailer in Smiggle and like
turnaround
overpriced
pajama.
pajama. And
Pajama.
I thought, good quote.
Yeah.
But I mean, when you think about retailers, like, you think Premier Investment, top of the pops, great management, or is there another way to start thinking about it, to Juliet's point?
No, I think you're okay. Premier is well run, very
Yeah.
fantastically run business. So like really comfortable with them. Some of their segments are slowing down a little bit. So to his point, I agree with that. I think you're looking for online, you're looking for some other kind of things, but consumer discretionary has been a really tough space all the way around. I think the consumer is still very gun shy. There's still cost of living issues. We'd need to see another 3 interest rate cuts before we really start to see them loosening their purses. So I think it's a little bit too early.
3 cuts from here or 3 cuts in total?
3 cuts in total.
Right, so another one.
What about, the thoughts of trying to get people into the bricks and mortar shops? Myer coming out with that very interesting move this week. Maybe Anita, your thoughts on trying to get the younger demographic, the blow dry bars, the beauty bars?
I mean, I can only speak from my experience. I'm mostly an online shopper.
So am I.
So, and a lot of it is just really the convenience.
Yes.
Groceries, everything. So, I mean, the loyalty side sounds really interesting. I definitely am driven by that side of it, but yeah, I mean, I've just got this habit now.
What about the marketplace? Like, do you believe that Myer will be able to build itself into this amazing marketplace? Because, if you go on their website, you may not, but they offer stuff on the site that they don't have in store. It's like that Bunnings sort of template. We've seen it, around the world. But do you think that might work for Myer if you don't go into the department stores anymore?
I don't know. You would need to have the loyalty to drive you to go to the Myer website. Like, why would I go there? Like, I can go to Amazon and pretty much get most things, and they come the next day. So I think it's going to depend on the proposition.
Mm-hmm. So interesting when you talk about online shopping. I'm probably going to regret saying this, but Carolina, our colleague, I've been paying $40 a month pretty much to get deodorant shipped to me online, paying the delivery, and I realized, talking about bricks and mortar, you can actually just get it at Priceline Pharmacy for less than I've been paying for like a year. I thought it was special. So yeah, it's one of those funny things. I'm very much an in-person shopper still, and every time I've bought online, I've been housed.
Yeah, well, look at me this week. I was sort of dominating the mailman, all the good slips coming
She had the good slip, the loading dock.
It was like, did you go on a big spree one night? I said, yes, I did. Luke, tell us about some small cap opportunities you're looking at.
Well, I was just saying to Anita before, the latest one I bought in the fund was E-Road, which Dawes you might know about because Shaw's covers.
That's been going gangbusters.
Yeah, and I think the reason why I moved pretty quickly on this one, normally I take my time, as you know, Anita, we talk about this a lot, I tend to do quite a bit of work, but this one feels like stocks like Gentrack, Catapult, Bravura over the last few years, where they were previously these high-flying tech stocks, have a few missteps, maybe poor acquisition, operational issues, whatever it may be. Market just baby out with the bathwater, and E-Road was like that. I think stock price went from $5 to 40 cents or something like that. Some management changes, but underlying it, they do fleet telematics for trucking companies, and they've always had a strong revenue base, $180 million NZ, forecast to go to sort of 200 mil this year, and it was just sort of at that level of revenue, you should be driving some level of operating profit. You just need some sort of fiscal discipline, some operating discipline, and a new management team sort of got them there. So it was a really strong, they had their full year results because New Zealand based company, the March year end, so their full year results were really strong, particularly that second half, and the outlook was pretty positive into FY26.
Yeah, absolutely.
I think, it's pretty small, couple of $100 million market cap, and a bit of liquid because they're dual listing on the New Zealand exchange as well, so it flies under the radar. But I think a lot of people will look at it and see those same similarities from a few of those other tech names, where once you get that sort of free cash flow recovery, the business can start to really leverage it.
Do you know it, Anita?
No, it's probably a bit small.
Bit too small for you. But you did mention management. Management, we ran an event here this week called 3 Stocks 4. You can still register. If you've missed it, you can still watch. But management was just, I can't tell you how many times it came up. Not just founder-led, but just how important management is.
Yeah, and I guess when you look at management, it's also looking at how they're remunerated. So what are their key performance indicators that they need to get their own income? So a lot of that will sometimes, drive the bottom line of how that company's going to be run.
So do you guys look at that a lot?
Oh yeah, that's definitely, and especially when they might change. So they might, introduce a new metric, or they might move away from a certain metric, whether it's ROE or EPS or the quantum of the what they have to get is changing as well. Then it kind of brings into question the thesis. So just making sure that, everything is hunky-dory.
And this is the thing, is that, we love DIY investors. We, most of our audience sort of is running their own money, but this is where, sometimes help can be necessary, because it's difficult for us as individual investors to understand what we're looking for and get that face-to-face time and everything else, which is important for you all three, I would imagine.
Yeah, I mean, so much of our job is actually just going around and meeting management and meeting competitors and understanding just the landscape. But, you meet management and it's something that you get with them, right? You can see how passionate they are about the business. You can see what kind of direction they are, what they're feeling that day, whether they're a little bit more timid or whether they're, more gung-ho and like showing the confidence, I guess, that they're giving about the business themselves.
But when we talk about bosses behaving badly, and one company comes to mind, people still buy in if it's a good company, right?
Yeah, I guess so, but there's plenty of companies out there. But I think skin in the game is the biggest thing, because you can have this management, they tell you all the stories, tell you how amazing everything is, but it's the skin in the game. How many shares do you own?
Yeah.
And what do you own in this business?
It's also what the split of their fixed remuneration versus variable.
Yeah.
So you want to make sure that there's more variable, so that they don't have to just turn up every day and they get paid. They have to actually do something.
Yeah, I agree.
So that was, I think, a segue to WiseTech. So it made a very big acquisition.
I thought it was mineral resources. I don't know what you were talking about.
I can feed it to you if you really want. But there was that massive WiseTech. And I will just say that we met up with the investment committee today. There was a discussion lively about WiseTech. The market voted with its feet, I guess, this week, and sending shares higher after the announcement.
Yeah, it's run pretty hard, hasn't it? I think you got to back Richard some way, because he is the company. He is the business, and it's 30% of his, and then with his friends, he's over 50% anyway. So you've got to really sort of understand how the business is run, and then if anybody was going to come over the top, he would be sitting on the sidelines, basically telling them what to say anyway. So market likes the business. Maybe they don't like the governance side of it, but they still like the business, and I think that's where the shareholders are voting at the moment.
So in the small end then, Luke, because you were talking about sort of tech companies, I know you're not interested in WiseTech. What would be a small company in the techie side that you think might stand to do well in this environment?
Put me on the spot.
I always do.
Yeah, you do. I actually have thoughts on WiseTech, though, if you want me to.
Oh, do you?
Well,
I do. I want them.
Just generally. I
don't want to pigeonhole anyone.
Yeah, well, it was big news, right? This is a big acquisition for these guys, and it's by far the biggest leveraged bet they've taken, and I mean that quite literally, because they're taking full debt on for this acquisition, and they're going to go from a net cash balance sheet to 3 times levered. So he's really got to make this work, and not to say he's betting the business on it, but this is the sort of thing, like, you often, when you see companies do sort of blow up, you often look back to something like this, where you've sort of bet the farm on a big acquisition, and if it doesn't pay off, that's usually what it comes back to. So I was a little bit surprised the market took it in stride so well. It's very much, Dawes, spot on, you're backing a jockey here, and you've got to have...
Not the horse.
Not the horse at all, because that business is a US listed business. You can go and look at the performance of it. It's been a struggling business for a while, so... Share price wise, maybe there's something in there that Richard White's identified, but it's a very, very big bet for that business. It'll be interesting to see how it plays out.
So you're on the fence. You're watching this from the sidelines happily.
Small cap investor, right?
I know.
Have an opinion.
But
it's funny, interesting.
Today we were discussing in the investment committee whether we trim our exposure to WiseTech or.
Yeah, I'd be trimming a little bit
Would
here.
you?
Yeah, absolutely. I'm trimming the rest of the market here as well. So, yeah, I'd be trimming some WiseTech. It's had a good run, so why not?
You're trimming?
I think you just need to be aware. We run a portfolio. We're 100% invested. That's what the mandate is. But yeah, I think it's good to have a balanced portfolio at the moment, just because you don't know what he's going to say tomorrow. It could be we're off to the races, all bets on, and then otherwise it could be disaster. I mean, we're at this kind of reprieve stage at the moment where we've got these 90 days. They're coming to an end soon, so we'll see what happens.
Anyone got any thoughts on Woodside, especially now that the government gave the go-ahead to the expansion of the Northwest Shelf?
It definitely opens Woodside up,
Yeah.
and that's what the market's been looking for, is some kind of good news, because it's been a horrible investment for the last sort of year to 2 years. There's still a lot of stuff to go on, so I think it's a positive step in the right direction for Woodside.
All right. I've given you time to think. I'm going to put you on the spot. So we got MA Financial. Sorry, this is unfair. We got MA Financial from you. I do recall last time you were here with us, sharing a drink. We'll get you one after. Superloop, and it came up again this week as being a company that hinged on how important management is. Is it still going well for you?
Yeah, and I'm still happy to back Superloop. I think it's, it is winning subscribers on the back of Origin. I think that Origin deal is going to be a lot bigger than what the market expects. Origin want to get more customers, so they're stickier for their electricity side. So they're going all in, and Superloop will benefit from that as they back them. They've also got other parts of the business that are going well, but I really think it's that customer side that's the consumer side that's driving that at the moment.
I'm a Superloop customer, and I got my email saying my price is going up to $95.
And are you going to pay?
I think I will. So there you go.
What else are you gonna do?
Pricing power, yeah. No, it's a good business, good service. Look, I do have one for you. Racing and sports technology. It's only very small, about $40-odd million market
Have you heard of it, Anita?
No, it's too small. These guys do like data and betting services, primarily Tabcorp, Sportsbet, Flutter, and Tane, big guys. They had a good update the other day. They've sort of come out and said their recurring revenue's up to about 20 mil. They'll probably do a couple of mil EBITDA on the back of that this year. So yeah, 40 mil market cap, it's about 20 times that, maybe 2 times ARR. I think it's a good little business, and growing steadily. They'll hopefully, if that ARR maintains, growing about 20% a year. So I quite like that one.
Don't ask me. Last time I said my small cap, it went from 32 cents to 24 cents in a day.
A big trading halt in between.
I'm not going to go, and I'm not going to. I'm just not going to add anything. Time out for me.
Well, I think we're almost out of time. I'm just curious as to, Anita sort of said at the top what you're thinking will happen towards the latter part of the year as we start to see these cracks. Maybe Adam, Luke, your thoughts on where the market's going.
Well, I've always said we're going to end the year higher than when we left it off at 8,600. We're so close to it now, but we've still got another 6 months to go. So I think there's a lot of information, a lot of Trumpism to go through, if that's a word, to work through. I still think at the end of the year we will be higher from where we left off. Mm-hmm. It's just going to be a rough ride going forward.
I agree with Anita's point before. The market wants to go higher, and I think you're pretty silly just to try and stand in front of that. I don't think you'll see any real weakness with earnings in August this year. Potentially the weakness might come back end of the AGM season when you start to get the FY27 guidance. Yeah, I think this year will be okay. So I see things doing okay, at least through to August, September. Maybe you get some of those jitters, depending on how AGM outlooks start to
Everything's
trickle
been
through.
pushed forward though, hasn't it? Yeah.
Well, but I mean, as I say that, I had the same concerns last year and probably the year before. I mean, I think we've all been waiting for this consumer cliff and this business cliff and whatnot. And corporate earnings have been super resilient for the last few years in the face of what probably was some weaker than expected economic data. So wait and see. And obviously valuations are even sturdier than that.
And is when we're reading these results in August, is Control F tariff what we should be looking for? Is that sort of the outlook in terms of how the tariffs are impacting companies?
I mean, there's so much uncertainty, isn't there?
Yeah.
I mean, what's the tariff going to be by then?
Yeah.
Who knows?
All right. Thank you.
I think that's left us all speechless. Let's see what the market's doing, shall we? Oh, and first of all, a huge thank you, Anita Costa, IFM Investors, Luke Winchester, Merewether Capital, Adam Dawes, Sean Partners.
Thank you.
All right, let's have a quick look at where the market is, up by 1/3% as we round out the session.
Nice finish there, Juliet.
Yes, indeed. And as we round out about 1/3% gain, we need our bartender to come in for our special guest. The Chardonnay Marius is in the fridge, I believe. All right, well, we will get the bartender to join us on set, but this is our special guest segment today. We have, there we go, we're on screen. Heath Campanaro and Simon Connell from Supergiant. Hello, great to see you guys.
Thank you for having us.
Now, this is all about Vivid, but before we get to that, because we're all very well versed with what Vivid is, what is Supergiant?
Well, what is Supergiant? We are a creative entertainment agency.
Yeah.
And we specialise in doing big public live experiences.
Okay.
So things like Vivid, we've done Glastonbury Festival in the UK, we do all the screen content for that, big stuff at World Expo. So we create beautiful things in big public spaces.
All right, well, let's have a look at some of the beautiful things that you've created, because you've collaborated here with Romance Was Born, the fashion house, for Vivid. We can see some of these beautiful images coming through here. I mean, Vivid is in its, what year now?
15th.
15th, and every year it blows us away even more. Si, tell us what you've created here.
Well, that was the big aim this time. Like we've with something like this, you have to set the bar's already been set high. You have to go one more, and so we had the luxury of Romance Was Born. It's such an amazing brand. They have a fashion house. They have such a breadth of work that we had to do justice to them. But it also just gave us the framework to kind of just go to town. Like a lot of the previous Vivids had, it's one artist and the look is very similar and it's telling the story through that. Whereas we had to kind of try and make a story and show the breadth of their artistry, but with lots of different looks. But it was a great problem to have.
Yeah, absolutely. I mean, I went to a chat the other night with Martha Stewart, and that was part of Vivid. So the whole program is just getting bigger and bigger.
That's extraordinary.
Heath, how much does it bring into the economy? How important is it?
Yeah, I mean, the stats will tell you that it's, $170 to $200 million into the Sydney economy at a time when arguably it needs it the most. It's winter. Sydney siders are terrible at getting out at the best of times, let alone, a bit of drizzle, a bit of a windy night. Oh, I might go back to bed or back home to watch TV. So the fact that it draws audiences from all over the country, all over the world, but even just out of their homes in Sydney, to come out and they might buy a burger or they might stay a night or 2 nights or 5 nights or whatever, that's the strategy. That's why Vivid was designed and created 15 years ago, and it was originally designed as an event that allowed lighting companies and projection companies to show off their technology, and it's very quickly turned into what it is today, which is an incredible opportunity for Australian artists first and foremost, but global artists to come and show what they can do. And I think when I reflect on what we do as Supergiant and similar types of things to Vivid around the world, nothing compares. And Australian studios like us, I mean, we're brand new, we're a startup, but other studios who have done work over the last 15 years are now on the world stage competing with the biggest studios on the planet and doing the best work, and Vivid's a big part of that.
So you talked before about how you've worked on Glastonbury and a number of other projects. Does it get to the point now where you go to these overseas giants and say, hey, we worked on Vivid Sydney?
Yeah, look, it's definitely great having that in your arsenal, right? To be able to kind of approach and entertain the ideas. Like we're already, off the back of this, there's already inroads being made into some opportunities in London, where we're kind of, looking to show off what we can do, off the back of Vivid. So it's a really exciting time. And as Heath said, it's great for us. And a lot of the kind of Sydney and Australian-based animation companies who can now hold their own, globally.
As a result of, having the Opera House as a canvas or having Customs houses. I mean, they're iconic buildings on the most beautiful harbour in the world, and we get to play with them every year. And the world looks to Vivid as the benchmark of what does large format projection and artistry look like. And that, hats off to Destination New South Wales for creating that and investing in it and growing it to the point it is now. And we're lucky enough to, we're in our first year and we got one of the icon buildings and we think we've done a beautiful job on it, and we just feel very fortunate to be part of it.
And it's not just the collaboration with Romance Was Born, there's music involved as well, right?
Yeah, absolutely. And something that was really important, both Heath and I are avid music lovers, but it's always a thing that in a projection light show that gets left to the last minute. And so we were really, made a point this time around going, if we're going to do this, that the music needs to work in harmony. Like that audio-visual connection is so important. And so we commissioned 7 local Sydney musicians, and and briefed them in to work on the show, and we held got the animation to a certain point, and then once we got those songs, we started to animate to those songs and created moments in the show that we could never have conceived of ourselves had the music not kind of added to that. So that was a really important thing, and I felt like that just gelled everything together, and has been probably, of all the feedback we get, the people loving the music, trying to Shazam it, right? And it doesn't exist. It was just for the show. So
creative.
Even to the extent that the artists now, maybe 3 of them, are looking to release the songs. I mean, they've only written like a minute for the show, but expand on them and release them as singles because they're getting such great feedback.
So let's talk more broadly about, you mentioned Vivid, Heath, brought to us by Destination New South Wales, your involvement, how long it runs for, and I guess what other part you play in this?
For Vivid this year, this is it. So
Yeah.
we have that one building,
Yeah.
and it's an 8-minute show, and it's, for those at home who kind of don't know what goes into that, we have 13 scenes hand animated from a blank piece of paper, 8 minutes of frame by frame design and animation created for that show. So there's a huge amount that goes into it. As Simon said, we're lucky that Romance was born. Their whole philosophy of them as designers is collaboration. So we had Ken Doan and Del Catherine Barton and Paul Yor and some of Australia's most iconic designers raw materials to work with to bring to life. So it wasn't just us collaborating with Romance was born, it was us. They were kind of the front door to some incredible artistry that allowed us to create this thing that is so multi-dimensional. 13 scenes in 8 minutes. Every minute looks completely different, and that's what we're really excited about and we're really proud of. It was a lot of work. And then, we hope, we've got Customs House this year. There's another building with a house at the end of it that we'd love to do next year.
I was going to say, is the Opera House on your agenda? Is that on your bucket list?
Of course. I mean, Si and I have been lucky to have done it a couple of times before.
Yeah.
In a previous life when we worked at a different agency, we were the creative directors for Sydney New Year's Eve, and also for the Royal Australian Navy Fleet Review, which was the biggest ever show on Sydney Harbour. So we created a half-hour show for the pylons and both sides of the Opera House, which is the first and only time that both sides have been protected. So we've definitely done the Opera House before, but never a Supergiant, and that's absolutely, the thing we want to do next, and we're excited about it, and we definitely feel like we've got the muscle for it. That's got to be the next target.
And by the time it comes around again, we'll have the energy.
Yeah, absolutely. I was going to say, an 8-minute show must have taken a lot of work. Really appreciate your insights on Ausbeers. Simon, Connell, Heath, Campanaro from Supergiant, and of course, as we mentioned, their beautiful artwork is being displayed on Customs House as part of Sydney's Vivid Festival. Let's have another look at where the equity market is tracking, up by 1/3%.
Well, there you go. There's the finish for the local market with the SIBO Australia Index up by 0.25%. So we had, Andrew, our market going its own way after a negative start on Wall Street.
We did, but look, I guess the Wall Street was more concentrated on Nvidia rather than the trade tariffs, tantrums.
Big, beautiful. Can we just
so
throw
much
out a
to
whole
talk
bunch
about.
of words?
Let's get to our economists. Great panel today. Illiana Jain from Westpac, Stephen Miller from GSFM, and Brian Parker from Australian Retirement Trust. Welcome to you all. Let's start with the obvious then, Illiana. Yesterday it was the tariffs are off with that obscure International Trade Court in Manhattan ruling, well, you know what, it's illegal. You can't do that. Trump says, well, of course they can. So he appeals. The appeals court says, well, yes, you can do that. So where does that leave us?
Yeah, so tariffs are back on, but for now they are temporary, and we don't really know how long that's going to last. Next week we're going to get a little bit more details. It might be that they actually do stay, but at the end of the day, right now, markets and investors are really focused on those tariffs are likely to stay. That's their baseline expectations. And that's really the world we're living in. We're going to have higher tariffs, and countries are getting prepared for it. We haven't really seen any government official, policymakers or market participants say that they're expecting those to come off completely. So right now that sentiment in the market is that the tariffs are here to stay.
I think actually that's a key point in all of this, is that we're going to get some form of tariffs, and whatever we get, whether it's a deal, is going to be an nth best outcome. It's a second or third or fourth best outcome relative to the baseline of, pre-Trump. And I think that's what markets are trying to get their head around, is sort of how bad is the news going to be. You know, I heard one of the earlier speakers talk about the markets responding to incremental news. I think that's probably right. That's what it is responding to. I'm not yet convinced that that's going to be the most profitable approach. That people are still, in my way of thinking, are quite complacent about what the implications are of whatever sort of tariff we get, which is not going to be good news. And you know, I sometimes wonder, being an old bond guy, I sort of wonder, is the bond market the only adult in the room, or is it the only pessimist in the room? And I'm sort of debating that in my own mind as to, you know, which one of those is right. Is the worrywart right, or is...
Well, Trump was paying attention there for a while to the bond market, wasn't he?
He was, but, you know, the 10-year yield's still around, in the US, is still around 4.5%. You know, if I told you, you know, back in January that the bond yield will still be 4.5% coming into June, you would have called that a brave forecast, I think.
Yeah.
And, you know, here we are, but... You know, there seems to be a disconnect between what the bond market's telling us in terms of inflation premia and headwinds to the economy and what the equity market's sort of telling us. And I can't quite reconcile that.
Jump in, because you've been nodding furiously,
Yeah,
Brian.
look, I worry that markets are a bit complacent here, because you look at the impact, and it's very much a brave new world for most people in the market. We've had decades of globalisation, and so this is a complete change of scene for so many people who just don't have any lived experience about what this kind of disruption looks like. And we're not seeing the impact of these trade shenanigans in the hard data yet.
That's true.
You know, we're seeing it in confidence measures, we're seeing it in consumer inflation expectations. In other words, Americans understand how tariffs work, even if their president doesn't, or pretends not to. They know they're going to pay it. And so it is hitting confidence, it's hitting some of the business surveys. But you know, how do you make longer term capital allocation decisions as a business when you don't know what the rules of the game are with trade? So I just wonder, you know, once, because I agree that, Stephen, that, you know, some sort of tariffs are going to stay. They will not be ideal, they will cause disruption, and once that disruption starts to figure in the data, maybe markets get a wake-up call then. And I do think that Trump cares about the markets. He may not pay attention to anything for more than about a day. Maybe I'm being kind with the day anyway. But once, if you see another leg down in markets, you could easily see another reversal on trade policy. You know, trade is a week-by-week proposition at this point. There's no way to run a business, let alone the largest economy in the world.
And is uncertainty like that's sort of the key thing? You know, it's all very well changing your mind and maybe watering down the impact of, say, the Liberation Day announcements. But as you say, you know, how do businesses sort of plan capex in that environment? How do households sort of think about their spending on big ticket items in that sort of context? You know, there's got to be, I think, some blowback on the economy at some stage.
Yeah. Well, and Illiana, how does the Fed make a decision going forward? And having said that, I should note that Donald Trump actually met Jerome Powell for the first time of this presidency this morning, and you know what he said? What are you doing? Why are your interest rates so high? You need to cut. What sort of pressure is that going to bring to bear?
It's like the least corrupt thing Trump has said this week.
Yeah, certainly. So I think we had the minutes out this week, and if you kind of do a Control F, tariffs was mentioned 32 times. What I was hoping to get was some sort of discussion around scenarios or any modelling they've done, or any sort of considerations to different scenarios of tariffs. That really wasn't there. We had a lot of the use of the word uncertain. So they're really doubling down that right now there's a lot of unknowns. They don't really know which way to go. They've got a dual mandate. They've got to keep the labour market fairly healthy. They've also got to keep inflation intact. And so you've got these two things that they're balancing. And at the same time, they don't really have much fiscal power like places like Australia. So we can, you know, if monetary policy needs to stay tighter to anchor those inflation expectations, we can get fiscal policy to come through and help some of those at pressure areas. But for the US, fiscal policy actually is at odds with monetary policy, and it's not particularly helping growth at the moment either. And so because of that, the Fed's in a little bit of a tricky situation, and the minutes basically articulated that. They said that these are uncertain times and we're waiting to see what happens, and we don't really have a view either way in terms of where we're moving. Now, our baseline expectation is that the Fed's going to remain on hold until they see the risk balance in one way or another. Either they start to see that inflation story really creep up, and then that's when they think about maybe making policy a bit tighter, or they start to see a material easing in the labour market, and that's when they start to cut. We're expecting that the first cuts are going to start in September, one in September, one in December, and from there they're going to remain on hold and really reacting to those downside risks to growth there.
How many central bank statements now mention uncertainty? How many times the RBNZ mentions uncertainty, the Bank of Canada, the
They need
ECB
to go to the
next
synonym.
week. Everyone mentions
AI help.
uncertainty. Yeah.
It kind of reminds me of 2020 and 2021, where we were using the word unprecedented a lot, and I feel like the word for this year is going to be uncertainty.
Yeah, you're right.
Well, I've got a new one.
What's that?
A stagflation light. So
That's two actually, but
well,
we'll let you get away with
it's
it.
got a hyphen in between.
does it?
Yeah. So I count that as one word. No. I sort of wonder, and again, this is sort of a little bit of an off-the-cuff thought, but I'm probably the only one here that's old enough to remember the 70s. People say if you do remember the 70s, you probably didn't really live them. But anyway, where we did have high inflation and high unemployment. I'm not saying we're going back to that world, but we could be going back to a world where in the US where inflation's stuck at 3 and activity subpar, and that's a new ball game for the Fed. In the 2 or 3 decades leading up to the pandemic, the Fed could always respond to, a downdraft by rapidly easing because inflation's quiescent. If it's not, for structural reasons, that makes, I think, which is what you're getting to, that makes their job extra hard, which is why they've got to sort of lean heavily on the incoming data.
Well, then throw in the big beautiful bill and the effect.
Well, again, fiscal policy. It's running counter to any inflation containment task that the Fed's grappling with. If you get a big beautiful bill with massive tax cuts, we all love tax cuts, but it's best that they're funded. And when the budget deficit's 6.5% of GDP and the economy's not far off full capacity,
Well,
that's
even
not a good
Elon
idea.
is not very impressed. Are you impressed with what? How do the chips fall in your world?
Look,
Brian?
at the end of the day, when you think about the budget deficit in the US, we now have decades of evidence that Republicans care deeply about the deficit, long as someone else is in charge. If they're in charge, they don't give a rat's. And that's abundantly clear. This is poor fiscal policy. It makes very little sense. And in fact, I don't see any appetite pretty much anywhere in the world to do anything meaningful about budget deficits and debt. I just don't. And given the kind of populist world we're in, given the sort of backlash against things like inequality, given the need for governments to step up and spend more on defence or climate abatement or whatever, I think we need to have a more serious conversation about the revenue side of the budget. We clearly want governments to do X, Y, and Z.
In the US or here
I think
everywhere?
more broadly.
Yeah.
So how are you going to pay for it? This idea that, and again, if you want to cut taxes and you're not prepared to do anything meaningful on expenditure, and frankly there's no political appetite to do that, well, this is poor fiscal policy.
Is it just buying votes? Like that's what some.
I don't know whether it is, because to me the kind of cuts they're putting in, put it this way, the tax cuts are going to people who vote for them anyway. The spending cuts, such as they are going to hurt people who, including sort of swing voters and non-aligned voters. I think it's bad politics as well, personally. It appeases the base, it appeases the donors, but I don't think it's actually good politics. I think the midterms are going to be rather interesting for this administration and for the Congress.
Let's turn to the local.
Oh, okay.
Yeah, shall we?
Sure.
Yeah, right. No, because there are interesting things happening. And Illiana, in fact, today we had retail sales. Consumption's still really lacklustre. So does that underscore, I guess, what we heard from the RBA and the fact that it was a more dovish statement than anticipated?
Yes, certainly. I think the weakness in consumption has certainly been something that's on our radar. We saw that our retail sales fell 0.1% on a turnover basis in the most recent data, and a lot of that came due to weather effects, was something that the ABS noted. But more broadly, when we're thinking about GDP come next week, we're looking for that handover between public demand and private demand. So far we've seen a lot of growth in government spending, particularly the NDIS, and that's held up overall GDP growth quite well. But going forward, as we start to see that easing in public spending, we're going to need private demand to start to pick up the slack. Now, this week we got retail sales, as you mentioned, and that came in a little bit weaker. And given some of the confidence measures we're seeing as well, the Westpac Consumer Sentiment Index still remains below 100, and though it is improving, it's still not quite at that optimistic level yet. That handover is likely to be shaky, and that's going to mean that growth is a little bit weaker going forward. The other aspect of private demand is, of course, investment, and we got CapEx numbers this week as well. We saw a decline in investment as well, so even though we have a fairly healthy pipeline, we're still seeing that, especially around equipment investment, businesses are quite hesitant to invest, and because of that, and that's coming before the impact of tariffs are fully realised. So once we start seeing businesses react to these tariffs, business intentions could be even weaker, and that's going to make that handover a little bit worse.
Well, it's so interesting, isn't it? Because when I speak to many equity analysts, they sort of look, I'm not saying smug in any way, but thinking that we're in a better position here in Australia when you look around the globe. I mean, I feel like we're being very negative. What's your view?
No. I think we are.
Okay.
You know, so I'd contrast the Fed and the RBA. You know, what I think Australia's done well is not retaliate in tariffs. You know, keep your head below the parapet, and in so doing, I mean, I think they can mitigate any inflation impact as a consequence of that. You know, there'll be supply chain disruptions and what have you, but the Fed's a bit hamstrung, A, by fiscal policy, and B, because of the price effects of tariffs. We're not facing that consequence anywhere near as much. So, and this is what I think Michelle Bullock was getting at in the last statement, that they can move decisively if the fallout from, you know, the trade ructions are drastic. They can cut rates quite easily whenever they want, whereas the Fed is a little bit hamstrung. So in that sense, we're better placed to respond. And I think, as you pointed out, you know, our budget is more or less in balance. It's not great, you know, the tax structure is sort of, you know, out of kilter, but, you know, there is sort of space there to move. So I do think policymakers in Australia have a few more degrees of freedom than those in the US. So I don't often give it to the equity guys, but I'll give them a tick on this one.
Yeah, I'm a bit more optimistic. I share your view. I think I'm a bit more optimistic than some. I think finally we're seeing some real wages gains. Yep. So those cost of living pressures that are still showing up in the confidence survey, I think once people wake up to the fact that they're actually a bit better off in real terms, you'll see some better sentiment measures, you'll see some better consumer spending numbers, I think, over the coming months. It's not I don't think you'll turn it off and on like a tap. I agree with the policymakers being more flexible than elsewhere. The direct impact of tariffs is relatively modest. I mean, we only, I think it's about 6% of exports go to the US, or give or take.
I suspect here they're ultimately disinflationary, not inflationary.
I think that's true, especially if we get hit. If it hurts China, the Chinese authorities are going to respond with massive stimulus, which means that'll help us, at least help mitigate the impact on us. And we're likely to get a bit of a disinflationary tailwind. You know, I've been telling people in presentations, if you're out in the market for an electric car, just hold off for about a year.
Oh, yeah?
Because we could be hit with a whole range. I mean, one person's dumping is another person's bargain.
Well, also all those Barbie dolls that apparently Trump won't go to the States. They're coming to us
if you're in the market for an electric car or a Barbie doll, hold 5 or 6 months.
Look, I've been speaking with everybody in the newsroom this week, probably annoying them, but thinking, JGBs, you know, what do we need to know? Like, give us, just for our viewers out there, the shorthand of what the JGB market has been telling us. Stephen, should we be concerned? Because, the premise of it was that if American exceptionalism is waning and that, you know, the absolute security and safety of the U.S. bond market is being tested. Well, you've always got the JGB market, but then there's been cracks showing in that. Is that correct?
I mean, we spent years worrying about the JGBs not increasing in yield, and as soon as they start increasing in yield, we start to worry again.
Okay.
I think the big message from the JGBs is, you know, Japan's finally got some inflation happening. You expect yields to rise in that environment. What it does mean, though, getting back to the US budget deficit, is who's going to fund the US budget deficit? Because Mr. and Mrs. Watanabe can now buy JGBs at a decent yield. And I think they actually benefit once you take account of the cost of hedging. So the Japanese are no longer going to fund the US budget deficit. I suspect the Chinese aren't that keen, and that's sort of shown up in the data already, to fund the US budget deficit. So I think you raise an interesting point. What's going on in the JGBs probably spells bigger trouble for the Treasury market than just the JGB market.
Yeah, I suppose that I'm thinking back to August when we had that big sort of yen blow up. Like for the average investor out there, it's hard to sort of keep your finger on the pulse of all these different things that are going. Like we're getting information out of this all the time,
Yeah.
and so you hear something like the JGB. Like, what's the shortcut? We just need to watch that market because it means that it's got a trickle down impact on all bond markets.
Well, JGBs and the Japanese market have traditionally been a reserve currency, aside from obviously the US alongside Europe as well. And so a lot of investors are probably thinking about, well, if I pull my money from the US, where else do I go? Now, Japan's been doing pretty well. Their GDP growth has been quite strong. They're getting inflation. They're finally starting to see exit that zero lower bound. And so that's a natural place to kind of allocate some of your money there.
Yep.
And so some of the concerns we saw in JGBs were at more the ultra long end, at the 20 and the 40-year auction mark. And so we're not seeing as much distress or concern around the shorter end. And today we got some of that, today we got the Tokyo CPI, and that came in much higher than most people anticipated. It came in up north of 3%, and it hasn't been that high for quite some time.
The Japanese have been trying to get that up for about 3 decades.
Yeah.
you know,
Yeah.
So,
So that's what I'm trying to figure out. Like, is this a good news story, bad news story? Like, or do we just sort of watch it from here in Australia and just see how it plays out?
I think you put it well. Like Brian put it well when he said, you know, we're all operating in a new environment. This is something that's this is not something that's within our experience. You know, this is a maybe a brave new world. Yeah, to use a hackneyed
Well,
phrase.
you've been around since the 70s, so you should
Well,
know.
you know, like I say, I can't. You know,
He's got his docs on, folks. Come on, cred.
you know, and I do remember them, so I didn't live them properly. But anyway, yeah, but no, it is. You know, we've talked about uncertainty and tariffs, and you know what side of bed President Trump gets out of in the morning. It's going to impact things. It is a very volatile, very uncertain world, and it's hard for investors. You know, so yeah, you know, like
Good luck.
well,
Good day.
no, it's good luck. But you know, so you talk about JGBs
Yeah.
or the bond market or what's going on in Europe or you know geopolitics, whatever. You know, it's a very, very difficult investment environment, and not one that's within the experience of even old people like me.
All right, we're going to have to wrap it. Yeah, final word.
I'll find the word. If you're a financial advisor or an investor going back, all you needed to do, if in the early 1980s, all you needed to do was buy long duration bonds and equities and go on holiday for 40 years. You come back and you've made a monster. But now it gets challenging.
I agree.
You've got to do your homework.
No, I agree.
You got to watch Ozbiz.
No, well, I think why it gets difficult is that, you know, that negative return correlation between bonds and equities is something of the past, and you know that's part of the new world that I was talking about. So
This is where I put a plug in for unlisted assets, by the way, just quietly. Yes.
You're allowed.
Brian, thank you for joining us from Australian Retirement Trust. And Stephen from GSFM, Illiana from Westpac. Than's for joining us.
Thank you,
much.
guys.
Thank you.
Cheers to the weekend.
Yep.
Indeed.
Speaking of which, we're almost there. So this is where we're ending up. So made a bit of a push towards the end there to be up around 0.25% on the CBO 200. So we're up for the week, up for the month.
Indeed, 3.6% gain on the month. What a good month in the month that was meant to be sell in May and go away.
Yeah,
Thanks to
Turn out,
Australian
did it?
Vintage.
But-
We're just topping up here
Oh, there you go.
quietly.
You girls are doing the trick.
Would you like a straw?
Here's the bottle, Andrew.
Thanks.
What do we say? I mean, what happens in June? End of financial year, we get some tax loss selling. You know, I feel like a broken record right now that it's all headline driven, right?
Yeah.
Well, it's the great unknown, and we've just been talking about that, haven't we? What's that, Shelley?
That was our boss yelling out. I'm not sure what was occurring. The bar is open clearly. Maybe we need to wrap it up this Friday.
Yep, all right.
What's happening next week?
We've got GDP,
GDP.
is the
Okay,
big
and
local
sorry,
one.
balance of
Also,
payments.
we've got jobs data out of the States as well. And, well, who knows what Donald Trump's going to do next week.
Yeah.
Because that court situation is going to unfold. I think it's the week after next, in fact, where they're called back into court. But is that going to resolve anything? You would think not at this point. All right, that leaves us for the week, for the month. We'll do it all again next week.
Cheers,
Have a great weekend.
Have a great weekend.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.